Good day, students. I want to begin with this question with the requirements. In tabular format, show the budgeted and the actual profit for the month of August based on the actual sales volume achieved. So we know that we are to calculate the budgeted and the actual profit or actual income statement or profit for the month of August. Requirement number 2 says calculate all the variable cost variances. All the variable cost variances for the month of August, and variances must be subdivided, meaning e.g. material must have total variance, meaning the price and the usage variance. So they just elaborating how we must account. Remember, when they say variable, it will be direct material variance, direct labor variance, and variable overheads variance. Only all these three divided into the two variants that are under each or subdivided. I will start responding to 2, then after I will do number 1. I love variance, to be honest. I'll start responding to the variance, then after do the budgeted and the actual income statement. Now, let us begin from the beginning and we read the information that is provided to us on our disposal. We know in our mind that we are to do budgeted income statement and the variances, only the variable ones, direct material, which is divided into price and usage, labor divided into rate and efficiency, and overheads that are variable divided into rate and efficiency. So now these are the variants that we're looking at. And once again, please make sure that you watch my other video on standard costing, because this topic is called standard costing. I do have a video that starts with the introduction of the formulas, and that question is in my website. It says chapter 16 standard costing, question 16.5. I first begin explaining the formulas because I do have the formula sheet. Then from the formula, then I go to answer the question and also align that with the formulas. So now in this question, I will not be going to the formulas, but I will be showing you the formulas before I do the calculation. So please refer to that introduction video. Very, very crucial. Now it says the monthly budget of steel work manufacturers of specialist cabinets was prepared on the following specifications. Now, the company budgeted to produce and to sell 30,000 units in the given month, the monthly budgeted. So this is a month budget, 30,000 units. The selling price is budgeted to be 80 Rand per unit, and the direct materials input, it is 5 kgs per unit, at a cost of 120 cents per kg. That means for one product that this company manufactures, the company expects or the company incurs or the company mixes 5 kgs of material in order for 1 unit to be complete. So just 5 kgs to complete 1 unit. And the cost to complete 1 unit is budgeted to, the cost to buy 1 kg is budgeted to be 120 cents. So now if we need to know the material price per unit, it will be the kgs that are required times this by the price per kg. That means the cost of material per unit, meaning the cost of the direct material to complete 1 unit will be 6 Rand. So now I will leave it there. We'll deal with that as we continue. Then now we have direct labor input, which is 2 hours. That means it takes 2 hours for the employees to complete 1 unit. And remember, they use 5 kgs of material to complete 1 unit. And those 5 kgs, each of them is bought at 120 cents. I want to remind you, although these two are different. Now, laborers take 2 hours to complete 1 unit, and employees are paid 4 rand per hour. That means the cost of labor to complete 1 unit will be 8 rand. Remember, now we're also looking at the direct cost now, meaning the cost of production. Remember, it is material, labor, plus manufacturing overheads. Our variable overheads are calculated at 2 rand per direct labor hour. That means again it's 2 rand times by the number of labor hours, the number of direct labor hours it takes to complete 1 unit. That means our variable overhead will be 4 rand per unit. That means it will be 6 rand material, 8 rand per unit of labor, and 4 rand per unit of the variable overheads. And when it comes to the fixed one, we are given the total as 110,000 for the full month that we're budgeting our production to be. Then I will continue on that same note. And remember, for the sake of the variance, we don't need these calculations for the sake of the variance. But for the sake of the calculation of the profit, we really need these numbers. Then now it says the following actual. So now this is actual information. This was budgeted. That means when we are doing the income statement, the budgeted income statement, we need to focus under the budgeted information. And the actual income statement, we need to focus under the actual information, or the actual profit. We need to focus under the actual information. Very important to highlight that. The actual results were recorded for the month of August. So now this is what actually has taken place. Remember, this was the budget for the month of August. This is what we budgeted, but in actual fact, this is what took place in the month of August. So now, let me just, before I come here, let me complete what I'm supposed to complete here. If we wanted to produce the number of units, that means the total cost of material to produce 30,000 units, it will be based on that 30,000. Therefore, now we have to say 6 rand per unit times by the number of units that we expect to manufacture. That means the total cost to produce 30,000 units in terms of material will be 180,000 rands. And the total cost of labor will be 8 rand per unit times by 30,000 units that we expect to manufacture. That means the cost of labor will be expected to be budgeted at 240,000 in total. And that of overheads, 4 rand times by 30,000, that means it will be a total of 120,000 rands. Remember, this budget is for the month. Now, when it comes to the fixed one, we do have 110,000 as a total. That means our total cost to manufacture 30,000 rands is budgeted at 120,000 plus 110,000, which is fixed cost, plus 240,000 rands, plus 180,000 rands. That means our budgeted cost to produce 630,000 will be 680,000 rands. Where now we have our total material, labor, overheads, variable, and fixed taken into account. So I'm already partly done with the budgeted profit, to be honest. Now I'm doing this because I know what I'm required to do later on. Otherwise, if it was not a requirement to calculate the profit, then I wouldn't need to calculate the total of these figures. So now we continue on that same note, and we are now looking at the next information, which is the actual information. Stock of finished goods at start, meaning the opening inventory, is there given to us. Sales were 40,000, production was 42,000, more than what we anticipated. We produced more than what we anticipated. Then we also sold more than what we budgeted. So now we continue on that same note. We have the stock of finished goods at the end of the month. They gave us everything in this question. There was no need for them to give us closing inventory. We could have calculated closing inventory by our own selves. Opening inventory plus production of 42,000 800. This is what was produced, production, minus closing or minus sales. It doesn't matter which one you have. Minus sales of 40,000. It should give us 10,800 as our closing. If closing was given but sales were not given, we could have said 8,000 plus 42,800 will give us inventory available to be sold minus the inventory that was sold, which is 40,000. Sorry, I've done that. Minus inventory that was left 10,800. This will give us 40,000 of sales. So sometimes this can be missing, or this can be missing, or this can be missing, or production can be missing. Anyone can be a missing item or missing unknown that need to be calculated. But they gave us everything in this case, which simplifies everything. Remember, I want to compare these two. When it comes to our budget, there was no opening and there was no closing. We budgeted to produce 30,000 and sell the entire 30,000. No opening and no closing. But now when it comes to the actual information, we do have the opening, which is actual opening and actual sales and actual production together with the actual closing inventory at the end of the period, which is the month of August. Now we proceed on that same note. Now it further says that we have actual costs that were incurred. Now we are coming to the real numbers. We have direct material cost with a total of 267,220. If you remember previously, our material was budgeted at 180,000. Obviously, it has to be very small because the budget was 30,000 units to produce, but now we produced a total of 42,000 units. Hence now the cost of material that we bought is far away from the one that we have anticipated to use. Then now we continue on that same note, and we are provided with the cages that were purchased. Now we are told that the company bought 213,776 kgs at 125 cents per kg. So now we bought material at 125 cents. But previously we budgeted that the cost to buy 1 kg of material will be 120 cents. If you remember, per kg is just on the other side. We anticipated 120 cents per kg, but now it becomes 125 cents. That means 120 cents minus 125 cents, multiply this by 213,776 will indicate that we have a price of material that is unfavorable. That means we planned less than what actually took place. So this will be the material price variance already. Then after we continue looking for the further information. Our labor is 356,577. We are given this information so far only. Our variable overheads 165,243. Remember, we don't know how much is the rate of labor that was paid to employees, but we know that our employees were being paid 4 rand or were budgeted to be paid 4 rand, but don't know actually where they paid 4 rand. Wasn't there maybe some wage negotiations that might have resulted to the wages going up more than we anticipated or we budgeted for? Our fixed overhead 115,000 rands. Now, very far away from what we anticipated. Previously, we had 110,000 rands. Now there will be a difference of 15,000 of 3,000. It was 110. We have 115. So there will be 3,000 rands difference. But we are not required to do the fixed cost variance. If you remember, only the variable cost. Let's read further. Further information says further information. Through August, the price paid for direct material was 1 rand 25 cents. So they just verifying that 1 rand 25 cents that it is really 125. There was no change of price when we bought our material from our supplier. It remained the same throughout. If there was a change, then we might need to calculate the average price throughout the month. Then material is used as soon as it arrives on the site. That means first in, first out method is used. No stock of material were held at the start or end of August. So there's no opening and there's no closing of raw material. And this is very important to be noted because we have inventory of raw material, inventory of finished goods, and inventory of work in process. And I'll leave it there for other chapters. Then we are further provided and told that our labor that was paid throughout the month to our employees was 410 cents. Previously, we estimated that employees will be paid 4 rand per hour, but now we ended up paying them 410 cents. That means we'll have an unfavorable variance where we say 4 rand minus 410 cents. Then multiply this by the actual hours. If you remember actual hours, we don't know actual hours yet, but we know that our employees were paid 4 rand 10 cents. This is how much was paid to them per hour. Now, in order for us to get to the amount of 356,577, which is the total amount paid to employees, we must have set the rate per hour 4 rand 10 cents, multiply this by the hours that employees have worked. We don't know how many hours these employees worked, but we know that it was 4 rand 10 cents multiplied by the number of hours these employees have worked, and this gave us total of the cost of labor that was incurred and probably paid, 356,577. So now that means we need to calculate the hours. That means this will be the hours equals the total cost. So now we need to say mathematically divide here by 4 rand 10 cents. This will cancel this. Whatever we do on the debit side, we also do it on the credit side. 4 rand 10 cents. For every debit entry, there is a credit entry. That means when we're looking for hours, we say cost of 356,577 divided by 4 rand 10 cents, which is the rate per hour, in order for us to get to the actual hours that were incurred or were worked by employees, which is 86,970. 86,970. Now I want to highlight this, and I've emphasized this in the previous videos also, that you might not be given this rate that they've given us under further information. They might give you the total cost and the total hours, and you must calculate the rate. So now the same thing, for us to get to the total cost, we would have said the hours times by the rate the employees were actually paid for. So now it will give us the total cost. When we are looking for the rate, we'll say the total cost again, 356,577 divided by the hours of 86,970. That means our employees were paid 4 rand 10 cents and they worked 86,970, and the total will be 356,000. By saying 410 per hour, multiply this by the hours that were worked. So the 4 rand 10 cents might not be given. Please be mindful of that, but still be able to calculate it. It's not a transmesh. So now we do have our actual hours. I'll be using the abbreviation very much in variance, but listen to what I say. Actual hours is AH. And there are different abbreviations that are used in variance analysis. So now this is 86,970. Let's verify. 356,577 divided by 4 and 10 cents. 86,970. This is our actual hours. Then now we are told that the selling price of the finished goods was 70 rand. Previously, we budgeted to sell our product at a price of 80 rand, but now we are selling them at a lesser price than we anticipated. So, meaning the selling price variance will also be unfavorable if we were to do the selling price variance. They say stock of finished goods are valued at standard cost of production. Stock of finished goods are valued at standard cost of production. I want to repeat this one. Stock of finished goods, meaning all the goods that are finished. When you say goods that are finished, now we are referring to the goods that are finished. This is the goods that are finished. That means the stock of these finished goods will be based at standard cost. Remember, standard cost is the standard information where we had the standard rate of will come to material. Material was 5 rand per kg, 120 per kg. This 6 rand is the standard price or standard cost, and the 8 rand is the standard information. This is what we do. We know that on standard we need to mix 5 ingredients for 5 kgs in order for our product to be complete, and we need to spend 2 hours of the employees, direct employees, in order for them to complete our product. So this is the standard information. That means when we are calculating now our finished goods value, it must be based on standard cost of production. And it's very important to highlight this, more especially when we are dealing with budgets and you're doing budget and actual and budgeted profit. Now let me respond first to the variance that need to be analyzed. Then after do the profits that is required also to be done. Now we begin on that note by writing our first variance, and our first variance, it is material price. Material price or material variance, not price, material variances. We have price. Our price says standard price minus actual price times by actual quantity purchased. Our standard price of material, it is 1 rand 20 cents. Our actual price, it is 1 rand 25 cents. Our actual quantities that were bought is 213,220. I hope my memory still serves me very well. How much material did we buy during the period? We bought material, total was 213,000 rands. It was somewhere there, yes. 213,000 rands, 13 kgs, 776. Now again, there was no need for them to give us this price, because the minute we know the cost and the total units, in this case being the kgs, we could have said the cost of 267,220 divided by 213,776. This could have given us the same 125 cents. So now let us write that 213,776 is our material that was purchased. 213,776, I was very close, 776. Therefore now we'll say times this by 0.05. Let me verify if I'm right. 1.2 minus 1.25 times by 213,776. We get an unfavorable variance of 10,688 rand 80 cents. This variance is unfavorable. We call it adverse, right? Unfavorable or adverse. Then we go to the second variance of the material, which is the usage, material usage. Material price, we focus on the price of the material per kg. Material usage, we focus on the kgs. We have what is called standard quantities minus actual quantities used times by standard price. Standard price, we know, is the same price that we had before. Our standard quantities is always calculated. Standard quantities is based on actual production. I always highlight that. In other words, we are saying we thought that, or we expected that we must use 5 kgs for every unit. So now standard is saying if we produced 42,800, then how many kgs were supposed to be used? So now based on standard, because if per standard we say we need 5 kgs for every unit that we do, then if we produce 42,800 units, then we can say 42,800 times by the required kgs per unit. That means the company is supposed to have used 214,000 kgs. This is how much the company is supposed to have used. The company is supposed to have used 214,000 kgs. But the company actually used how much? The company used 213,776 times by the standard price of 1 rand 20 cents. Times by 1 rand 20 cents, then we'll have a variance here that will be a favorable variance. Minus 213,776 equals times by 1 rand 20 cents. We get a variance that is favorable, and this will be 268 rand 80 cents. Then you say minus 10,688.80. Then this will give us a net variance that is unfavorable. This will be 10,420 rands. This is adverse. This variance is favorable. This is favorable. Please write the full naming. I just have limited space. A mean adverse or unfavorable. You can say if you want the unfavorable, and you can say the net here is unfavorable, which is adverse, the same thing. Now we are done with the material variance. Then we go now to our direct labor variances. We have rate, because employees are being paid a rate and they spend hours. It will be standard rate minus actual rate times by actual hours. Standard rate, we know that it was 4 rand that we budgeted. Actual rate was 4 rand 10 cents, and actual hours is 8,970. I hope my memory still serves me on that. 8,970. Verify that. Yes. Or 86,970. It is 86,970. That will be our actual hour that we worked. Then now we look for that variance. Check if it favorable or unfavorable. Unfavorable, obvious. 4 rand minus 4 rand 10 cents times by 86,970. This will be 8,697. That will be adverse, meaning unfavorable. If you want unfavorable, because we paid a higher cost than we're supposed to have paid. Then we go to the labor efficiency. Our labor efficiency is standard hours minus actual hours times by standard rate. Now standard information is always based on actual production. In other words, we go to our standard hours. We say our standard hours per unit are saying that we're supposed to spend 2 hours to complete 1 unit. So now if the company actually produced a total of 42,800 units, how many hours were supposed to be spent there? That is the answer to the question. If the company spent a total of this and we are supposed to have spent 2 hours for every unit, how many hours the company is supposed to have spent then? That is what is called standard hours. We say standard rate per unit or standard hours per unit times by actual production, 42,800 all the time. This does not change. Very similar with the standard quantities of material. It is 85,600 hours. That means the company is supposed to have spent 85,600 hours. So we say this is what you're supposed to have spent, 85,600. But how much have you spent? 86,970 actual hours. If you remember, that is the actual hours. 86,970 times by the rate, and the rate is standard 400. So now we can see that this variance will be unfavorable because employees spend more time than they're supposed to have done so. 86,970 will indicate that 1,370 is an unfavorable variance. It's very unfavorable, this variance. Then now we have to calculate the total of the two variants to determine if the net is favorable or unfavorable. Then we say plus 8,697. Then this gives us 7,327. We can say that the net of this variance is favorable. So this will be favorable variance. 7,327. Then we do now our overheads variance. Let me be they said variable, so we know that we're focusing only on variable. Overhead variances or variances. Now that means we look at the rate again. This is the rate. It is standard. This is very similar to the labor. It's the same language when it comes to the labor variance. Standard rate minus actual, standard hours minus actual hours. Standard rate minus actual rate times by actual hours. So now we say our overheads were 2 rand, if I'm not mistaken. We anticipated 2 rand to be incurred per hour. Yes, 2 rand per direct labor hour. 2 rand per hour minus, we need to look at the actual rate now of the variable overheads. We were not given our actual, but we were given the total when it comes to the variable overheads. We have variable overhead 165,243. If we need the rate here per hour, we need to divide by the actual hours, 86,970. Remember, this was based on labor hours. They said previously that our variable overhead is 2 rand per direct labor hour. That means our overheads are absorbed based on direct labor hours. So now because of that, we can then say 165,243 divided by 86,970. This will give us 1 rand 90 cents. 1 rand 90 cents is the actual cost of variable overheads, which is less than what we anticipated. Times by actual hours, 86,970. So now this will give us a variance that is likely minus 2 times by 86,970. This will be favorable, 8,697, and it is variable. Remember, the reason why I'm saying favorable is because we said 2 rand that we budgeted minus 1 rand 90 that actually took place times by 86,970. So that is where that 8,697 is coming from, and is favorable. Then we come to the variable overheads efficiency, and efficiency says standard hours minus actual hours times by standard rate. Standard hours is the same as we calculated before. It is the same as 85,600 minus 86,970 times by the standard rate of 2. Then this will give us our variance. Then the total will be the last variance as my page is ending. So now we have 85,600 minus 86,970 times by 2. This gives us 2,740, and this is unfavorable. If the labor efficiency is unfavorable, the overhead efficiency will always be unfavorable. Plus 8,697. This will be 5,957. Remember, this is unfavorable. This is unfavorable or adverse variance. The net will be favorable because the variance which is bigger is favorable, and the one that is unfavorable, it's a small amount. Now with the variance I'm done. Very short question, to be honest, not that much to do and not that much to explain. I've covered well details for this, guys, explained this very well in other videos. So here I'm just dealing with the number that are there, to be honest. There's not much. Then now we go to the first requirement. This was 5.2. This was 5.2. Then now we do 5.1, the profit statement. And we are to do the profit statement in tabular format, budgeted and actual. We are required to do budgeted and the actual statement. Show budgeted and the actual profit. So now we need to have budgeted and we also need to have the actual profit. Then we know that we begin with sales, then after we have what is called cost of sales. Cost of sales will definitely have to be negative. Then now we need to calculate our sales. Let us listen to the requirement. There was a sentence that said stock of finished goods are valued at standard cost of production. So now we need to say, and in the requirements they said based on the actual sales volume. We must use the tabular to show the budget and the actual for August based on actual volume achieved. So now that means we are using the actual sales volume that we achieved. Then I will say how many units were sold. How many units were sold? We sold a total of 40,000 units. 40,000 units, we need to multiply it by 80 rand because this is our budgeted selling price. Our budgeted selling price remains 80 rand. Although we are basing it on actual sales volume, we still use the budgeted selling price. It gave us 3,200,000 rands. Then 40,000 rands. 40,000 rands, we multiply this by the actual selling price now under the actual statement. Actual selling price was 70 rand. So we get 2,800,000 rands. We get 2,800,000 rands. Then under our cost of sales now we need to have our opening, production and closing. But for the first one there was no opening, production and either closing. So now we just need to calculate our cost and we paste them as they are. And we have already calculated 680,000 rands. Remember, if you have done the workings for this, you don't need to be showing them. You can just say 680,000 rands if you have done the calculation somewhere else. If you have not done them somewhere else, then you need to show your workings and say now, but I don't want to, okay, let me say opening plus production minus closing. Here there was no opening and our budgeted production is 680,000 rands and there's no closing. So my cost of sales remains the same amount. That means I should have budgeted cost. I must have had a calculation that says budgeted cost, where I have my material, and my material will be 120 times by 5 times by 30,000. I must have shown this calculation somewhere. Times by 5 times by 30,000. I've done that workings. 5 kgs times by 120, it gave us 180,000 rands. So that will be 180,000 rands. Then we have labor, which is direct labor. Direct labor is 4 rand times by 2 hours times by 30,000 units. And this gave us a total of 240,000. So this is 240,000 rands. Variable overheads, and that variable overhead is 2 rand times by 2 hours times by 30,000, and this became a total of how much? A total of 120,000. 120,000 rands. Then after we had our fixed cost, which is already in total. Fixed cost 110,000 rands. So calculating the sum of all of this will give us 680,000. 110,000 plus 120,000 plus 240,000 plus 180,000. It is 650,000. 180,000 plus 240,000 plus 120,000 plus 110,000. It is 610 that I verified it. It is 650,000, not 680,000 as I mistakenly have done so. We have 110, 120, 180 and 240. So that will be our totals. We have 110 plus 120 plus 240 plus 180. Yes, it is 650, not the 680. It is 650, not the 680. Sorry for that one, just some error in calculations. So our cost will be 650,000. That means we have 650,000 here as our cost of production. That is budgeted. Now we go to our actual information. Our actual profit, there's something that was highlighted and is very crucial to note. They said to us that the cost of production must be based on standard cost, or the production must be based on standard cost. Let me go to that sentence. It said, stock of finished goods are valued at standard cost of production. So now our standard cost of production, we now need to calculate our standard cost per unit. Because our standard cost, we have it as in total, but we need to calculate our standard cost per unit. Our standard cost per unit. We have material. Our material, we calculated it to be 1 rand 20 cents times by 5 kgs is 6 rand. labor was 8 rand, this is 4 rand, direct labor, variable overheads, it is 4 rand. Then we have our standard cost. Our standard cost will be 6 plus 8 plus 4. Our standard cost will be 18 rand. This is our standard cost. It's our variable standard cost. Let us check if we responded to that. Stock of finished goods are valued at standard cost of production. So that is our standard cost of production. And we know that our fixed cost actually became 115,000 rands. So we need to be mindful of that one and don't include it in our standard cost. So now meaning our variable cost of production now in the income statement will have to be based at standard cost of 18 rand, which is 18 rand per unit. Then now we come to our opening, which will also be based on the 18 rand. And we look at the opening inventory. How much of the opening inventory? We did have opening inventory. And our opening inventory, these are the finished goods. It is 8,000. Now the opening inventory must also include the fixed cost. Now in this case become a little bit tricky because we have fixed that is budgeted at 110,000 rands, and we have actual which is 115,000 rands. That means in the calculation now of our cost, meaning in the calculation of our cost, we need to account for the fixed cost so that our opening inventory will also include the fixed cost. So now that means we need to say this is the variable production cost, and we need to say plus fixed cost. Plus fixed cost. And our standard fixed cost will be calculated at 110,000 rands divided by 30,000 units. That means this will be 3 rand 67 cents. This will be the amount of the fixed cost per unit. So now it will be plus 18 rand, and this will give us 21 rand 67 cents. So this will be our standard cost, including also the fixed portion. So now that we have covered that, we have 21 rand 67 cents. Then we can say 21 rand 67 cents, multiply this by 8,000. This will give us the opening inventory for the actual at 173,360, and 21 rand 67 multiply this by 42,800, which is production. It will give us 927,476, and our closing, which is 10,800 times by 21.67, it will give us a total of 234,036 and 36. Let us just verify the numbers. Closing, yes, it is 10,800. We say 21.67 times by 10,800. Yes, that one is correct. So now let us conclude the calculations now and do all the calculations. Remember, the cost of the finished goods is based on standard cost. What does this mean, to be honest? This means that when it comes to the actual cost of production, we don't take the figures that are given to us, because we do have already the actual information, and we do have the actual cost. There the direct material, there the direct labor, there is the variable overheads. The figures are provided to us, but now we don't take these figures in this case Why? Because we are told very clearly, I want to highlight this, we are told very clearly that stock of finished goods are valued at standard cost of production. I want to highlight this one. Stock of finished goods are valued at standard cost of production, and our standard cost of production is based on the budgeted information. This is where we get our standard cost of production, obviously removing that which is 650,000 now. So now we have calculated our standard cost per unit, and our standard cost per unit gave us 21 rand 67 cents. So now we use this to calculate the value of the stock of finished goods, and these goods are finished. These goods are finished. The opening of 8,000 is finished. I'm referring to the actual now. The production of 42,800 is finished, and the closing inventory of 10,800 is also finished. So now because of that, we value it at the standard cost. So that becomes the value of the finished goods, not the value of the closing stock. Because sometimes they will say the value of the closing stock is based on standard cost. But now they say stock of finished goods are valued at standard cost, not stock of the closing inventory. I'm highlighting this because it's quite important. So now let me go there and we'll say minus 927,476 minus 173,360. This gives us 866,800 plus 2,800,000 rands. This gives us 193,000 or 1,933,200, and this is the profit for the actual information. Then after we have 3,200,000 rands minus 650,000 rands. This becomes 2,550,000 rands, and this is what we call the gross profit. This is the gross profit, or the profit based on budget and the profit based on actual. Don't forget to remove that one to be 650, and you know where that calculation is coming from, the correction is coming from. So guys, this is very important. Remember, in the case where they don't tell you the sentence, or maybe where the sentence is not given to you, then you just need to take your actual cost as your actual income statement, unless it is based on standard cost of production. So in this case, then now we need to account for it in this manner. So now with that, guys, we just look at other dimensions. We are not doing absorption costing here, so we don't need to take into account the over or under applied manufacturing overheads. But if that were the case, then we'll need to take into account the over or under applied manufacturing overheads. It's just a normal profit statement that we are required to do. With that, guys, thank you for that. We have covered the requirements that were required in this question. God be with you. Thank you very much.